Namaste. In this video, we will discuss about the derecognition of financial assets. The financial assets in the financial statements of an organization will be derecognized only and only when right to cash flow from the assets has expired or the asset has been transferred. So there are two conditions that we need to check whether the cash flow right has expired or the financial assets has been transferred, and for the purpose of checking the eligibility of derecognition because of the transfer of the financial asset, we need to apply the derecognition test. First, we will check about the risk and reward test, and secondly, we will check about the control test. So first we need to apply the risk and reward test. After that we will apply the control test. And for the purpose of derecognition, it has to be applied at consolidated level. So first we need to consolidate all the subsidiaries of the entity, and after that we need to apply the derecognition principles. And in case of individual financial statements, we are not supposed to apply this step, and the transfer has to be in substance, which is evaluated by using a risk and reward test and control test. So only legal form of transfer is not necessary principle for derecognition of financial asset. We need to check the substance of the transfer. When we are evaluating about the derecognition of financial assets, we need to evaluate up to what extent the derecognition principle should be applied to financial assets or group of similar financial assets. While evaluating, we need to check about the derecognition will be applied on part of financial assets or it has to be applied entirely on the financial assets or group of similar financial assets. To identify regarding the partially application of derecognition principle or fully application of derecognition principle, we need to check some conditions. So partial derecognition will be applied if the test met any one of the below three criterias. For example, if the part comprises specifically identified cash flow from the financial assets or group of similar financial assets. For example, when an entity enters into an interest rate strip where the counterparty obtains the right to interest cash flow but not for the principal. So in this case, the derecognition principle will be applied on the interest portion of cash flow only, not on the principal. Second condition is if the part comprises pro rata share of cash flow. For example, the counterparty obtains the right to 90% of all cash flow from the financial assets or group of similar financial assets. In that case, the partial derecognition will be applicable on the 90% of the cash flow. Third condition is if part comprises pro rata specifically identified cash flow. For example, when an entity enters into an arrangement whereby the counterparty obtains the right to a 90% share of cash flow of a debt instrument, in that case, derecognition rule are applied to the 90% of those cash flow. So, when we are checking out the derecognition criteria and any of the three conditions are satisfied, in that case, derecognition will be applicable on the partial financial assets or group of partial financial assets. In all other cases, it has to be entire derecognition of financial assets or group of financial assets. We are evaluating a financial assets or group of similar financial assets for the purpose of derecognition. The first step is to check whether the right to cash flow from the financial assets have expired or not. If we found that right to cash flow from the financial assets or group of similar financial assets have expired, we need to derecognize the financial assets from the books of accounts. For example, if the loan receivables have been repaid, it means the financial assets does not carry any right to cash flow from that assets, and the purchase options remain unexercised. It means that there is a no right to cash flow from those unexercised purchase options, or there is no reasonable expectation of recovery of financial assets. In all these cases, the right to cash flow from the financial assets have expired. So the first condition has been fulfilled, and in this case we will directly reduce the gross carrying amount of financial assets or group of similar financial assets. When we evaluate regarding the derecognition of the financial asset, the first condition we need to check whether the right to cash flow has expired. And in case the right to cash flow has not been expired, we can transfer the asset only and only in case the financial asset has been transferred. And to check the criteria of transfer of financial assets for the purpose of derecognition, it should meet the qualification criteria of derecognition. For example, it has transferred substantially all risk and rewards related to financial assets, or it has neither transferred nor retained substantially all the risk and rewards and has not retained control of the asset. The transfer of financial asset may be subject to certain conditions, for example, contractual warranties relating to the existence and value of transferred cash flows at the date of transfer. It means, for example, warranties with respect to the borrower having met the specified lending criteria when loan was advanced and that loan repayment are not in arrear at the date of transfer. Another case may be conditions with respect to the asset's future performance. For example, warranties that all repayment will be made when due. So, if right to cash flow has not been expired, but the asset has been transferred, subjected to all these conditions, then we can only derecognize the financial assets. In the pass-through arrangements, an entity although retain the right to the cash flow, but side by side, it assumes responsibility to transfer those cash flows to one or more recipients. So in these cases, actually the entity who has retained the right to the cash flow act as an agent of the eventual recipient of the cash flow that derive from the asset. So when we are checking the pass-through arrangement, we need to check below conditions whether there is a no obligation to pay unless it has been collected. So in these cases, however, short-term advances by the entity to the eventual recipient with the right of the full recovery of the amount lent plus the interest at the market rate do not violate this condition. So this condition will be satisfied if there is a no obligation at the part of entity unless it has received or collected cash flow from the financial assets. Another is if the entity is prohibited by the terms of the transfer contract from selling or placing the original financial asset. But in this case, transfer may be as a security to the eventual recipient for the obligation to pay them cash flows. And the third condition is where an entity has an obligation to remit cash flow, it collects on the behalf of the recipient without any material delay. However, the entity is not entitled to reinvest such cash flows except for the investment in cash or cash equivalent. However, there may be some delay between the collection date and the remittance date based on the administration purpose. So, if all these conditions are satisfied, in that case, we need to evaluate transfer of risk and reward and transfer of control to decide the derecognition of the asset. And if these conditions are not satisfied, we will continue to recognize the financial assets in the books of accounts. So this is all about the pass-through arrangement. An entity has transferred all the risk and reward arise from the financial asset that it owns. It will derecognize the financial assets from its books of accounts and will recognize any financial assets or financial liability generated because of the terms and conditions of the transfer of that financial assets. So, when we are evaluating the transfer of risk and reward, we need to evaluate it based on the exposure in respect of the financial assets before it transfer the financial asset and after it transfer the financial asset. So this exposure will be just based on the variability in amount and timing of the cash flow related to the financial assets. An entity will be considered as a retaining risk and reward if the exposure to the variability in present value of the cash flow from the asset does not change significantly. For example, there may be a case when the asset has been transferred, but entity has an agreement with the buyer that it will buy that financial asset at fixed price. So in this case, the variability exposure in the value of the financial asset always remain with the transferor. So it means in substance the asset is not transferred and the risk and reward in respect of the fluctuation in the present value of the cash flow from the assets remains with the transferor. In another case, it will be considered as a transferred if the variability is not significant in relation to the variability in the present value of net cash flow of the financial asset. For example, if an entity has transferred the financial asset and has option to buy back at the fair value at the time of purchase. So in this case, the transferor has transferred the risk and reward to the purchaser of the financial asset. So in this case, it will be if it is considered as a transfer, so we will de-recognize the asset, and if we considered it that the risk and reward has been retained by the entity, in that case we need to continue to recognize the financial assets in the books of accounts. And for the purpose of comparing before and after exposure, there is no specific guidelines in IND AS 109. So we need to exercise the judgment at this part. In respect of the retention of the control of the financial asset, if an entity neither transfer nor retain substantially all the risk and reward related to the financial assets that it owns, in that case we need to determine whether it retain control of the financial asset or not. If it is determined that it does not retain the control of the financial asset, in that case we will de-recognize the financial asset, and if we determine that entity retain the control of the financial asset, in that case we will continue to recognize the financial assets in the books of accounts. For the purpose of evaluating the control, it does not have the same meaning as is attributed under IND AS 110. So to check the financial assets control, we need to check whether the entity has practical ability to sell the assets to an unrelated party. So if the asset can be sold to an unrelated party, it means it has lose the control over the asset. Another condition is that it entity has ability to sell the financial asset and it can exercise the judgment unilateral and without imposing any additional restriction on the transfer. So if all these conditions are satisfied, in that case there is no control of the asset and asset will be recognized. And if it is not have the practical ability to sell the assets to a related party, or the decision cannot be exercised unilaterally, or it has some conditions on the transfer, in that case it is considered that it has not transferred the asset, it has retained the control of the asset. In that case we will continue to recognize the financial assets in books of accounts. Accounting for derecognition of financial asset. If entity has transferred the financial asset and because of the transfer of financial asset, it qualifies for derecognition of asset in entirety. In that case, we need to recognize in profit and loss account the difference between the carrying amount of financial asset and some of the consideration that we have received for transfer of financial asset, including after adjustment of value of financial assets that we have acquired or financial liability that we have assumed, and any cumulative gain or loss that has been recognized in equity. So This amount we will recognize in P&L at the time of derecognition of financial asset. But if the derecognized asset is equity instrument and that is classified as equity OCI, in that case we need to recognize gain and loss in OCI, and there will not be recycling of gain or loss in OCI to profit and loss account. And for the assets, financial assets and financial liability, or any servicing liability that we have assumed because of the transfer of financial assets, we have to recognize FA, FL or servicing liability in books of accounts. In another case where there is a transfer of financial asset but it is in partially, in that case we need to allocate the amount between transferred and carrying amount based on the fair value of the asset transferred, and the accounting will remain same. We need to recognize in PL difference between the allocated carrying amount and sum of consideration received, including adjustment for FA or FL assumed and any cumulative gain or loss that has been recognized in equity. And if derecognized asset is equity instrument that is classified as equity OCI, we need to recognize gain and loss in OCI, and there will not be recycling from OCI to P&L. And similarly, if because of the transfer we have assumed any financial liability or have acquired financial assets or any service liability has been generated, we need to recognize the FA, FL or servicing liability in books of accounts. So this is all about the accounting for when an entity transfer the financial asset, it may generate servicing asset or servicing liability. It may be in form of collecting payments as they fall due, or remitting principal and interest payment to transferee, or NPAs executing foreclosures, or carrying out accounting and administrative tasks. So all these assets and liabilities, those are generated in form of servicing at the time of transfer of financial assets, are not financial instruments because these can be settled only by providing the services. So in this case, if the fee received for servicing the asset or liability is more than the compensation for the servicing, in that case, we need to recognize it as a servicing asset for the service right because the fees expected to be received is more than the cost of providing the service. In opposite side, if the fee to be received is not expected to compensate for performing the servicing, in that case, we need to recognize servicing liability for service obligation because the fee is lesser as compared to the cost of servicing of it. And if the benefit of servicing exactly compensate the cost, in that case we need not to do anything because there is no servicing asset or servicing liability as the fair value of service contract is zero. And servicing assets and servicing liabilities are subject to measurement requirement of Ind AS 113 at the initial recognition, and subsequent measurement at FVTPL is precluded because fair value option is available to the financial items also, and servicing assets and liabilities are not financial instruments. Apart from it, there is no servicing liability to the extent of continuing involvement of the asset. For example, if the asset pre-transaction was rupees 100 and the continuing involvement in the asset after the transaction was 70, the transferor would recognize a servicing liability for the 30 only that has been derecognized. It would not recognize a servicing liability for rupees 70 which is not derecognized by the entity. So this is all about the servicing assets and liabilities. Transfer that do not qualify for derecognition. There may be cases where entity has transferred the assets, but it has retained substantially all the risk and reward related to transfer assets. In that case, it will not qualify for derecognition of assets from its books of accounts. In this case, we need to continue to recognize the financial assets, and we will recognize a financial liability for the consideration that we have received against this financial asset. Apart from it, we need to recognize any income on the transfer assets and to recognize any expense that has incurred on financial asset. For example, if assets could not be derecognized because of the guarantee provided by entity, so in this case of continued involvement, India is required that entity need to measure the transfer asset at the lower of carrying amount of the asset and the maximum amount of the consideration received in transfer that the entity could be required to repay. It means the guarantee amount. So the assets will be measured at lower of carrying amount of the asset or the guarantee amount. Apart from it, the associated liability to be initially measured at guarantee amount plus fair value of the guarantee, which is normally consideration received for the guarantee. And if transfer asset continue to be recognized, in that case, the liability and assets not to be offset with each other and no offset of any income from transfer asset with any expense incurred on the associated liability. In case of non-cash collateral is transferred by the transferor to transferee, accounting of non-cash collateral will depend on the right of transferee to sell the asset or right to replace the collateral at the default of the transferor. So in this case, if the transferee has right to sell or replace the asset, in that case it will reclassify asset in its balance sheet separately from other asset. For example, as a loan asset, pledge equity instrument or repurchase receivables. And in this case, the transferor retains all the risk and rewards of the ownership of the asset that is placed as collateral, and therefore it cannot derecognize it under the normal rules for derecognition. If the transferee sells the collateral that is placed to it, in that case, first it will recognize proceeds from sale of collateral and simultaneously it will recognize a liability that is measured at fair value for its obligation to return the collateral. And the transferee will not recognize the collateral as an asset as it has already sold it. And if the transfer defaults and is no longer entitled to redeem the collateral, in that case, it will de-recognize the asset and the transferee will recognize asset at fair value and will de-recognize the obligation if it has already sold the collateral. In case of continued involvement in transfer asset, where entity neither transfer nor retain substantially all the risk and reward, but control the assets. It retain the control of transfer asset. In that case, we need to continue to recognize the transfer asset to the extent of involvement. So, what is the extent of involvement in transfer asset is? So, accounting will depend on that. So, continued involvement may takes different form. For example, if there is a guarantee about the transfer assets, the extent of involvement is lower of the carrying amount of the asset and the guaranteed amount. So to this extent, the entity will continue to recognize the transfer assets in its books of accounts. Similarly, continued involvement may take form of a retain or purchase option or both. So in this case, the involvement extent is the amount of transfer assets entity may repurchase, and in case of return put option on the assets that is measured at fair value, the involvement extent will be lower of fair value of the asset or option exercise price. So ultimately the risk to which the entity is exposed to. Apart from it, to the extent the entity need to recognize the assets in the similar way, it need to recognize the associate liability also. And similarly, it will recognize the income as well as expenses that is correlated with the transferred assets, but there will not be offsetting of income and expense in case of continued involvement of the transferred assets. Measurement of transfer assets and associated liability. In case if a put option is written by entity or call option right held by entity, in this case it prevents a transfer of assets being derecognized, and if the entity is measuring the transfer assets at amortized price, in that case the measure it will measure the associated liability at cost, and it will adjust it for the amortization of any difference between the cost and amortized cost of transfer assets. For example, if a carrying amount of the asset is 98 and the consideration that received is 95, and at the date of exercise the option price would be 100, in this case the difference between consideration received, that is 95, and option exercise price at excise rate, that is 100, so it will be recognized in P&L using ARI method, effective interest rate method. And if option is excise difference between the carrying amount of associate liability and excise price will be recognized in profit and loss account. So this is where the entity measure the transfer assets at amortized cost, so accounting will flow in this way. Measurement of transfer assets and associated liability. In case entity has a call option, and because of this it cannot derecognize the transfer assets, and the assets is measured at fair value, in this case the associated liability will be measured at lower of option exercise price less the time value of money if the option is in money or at money, and in case fair value of transfer assets less time value of option if the option is out of money. So in case if the option is in money or at money, it will be measured at option exercise price less time value of money, and if it is out of money then fair value of transfer assets less time value of the option. For example, if the fair value of asset is 80 and the option exercise price is 95 and the time value of the option is 5. In this case, as is it in money, so it will be measured at option exercise price, that is 80, and deducting the time value of option, that is 5. So the carrying amount of liability will be measured at 75. Measurement of transferred assets and associate liability, where entity has written a put option and it prevents a transferred asset being derecognized, and the entity measured the transfer assets at fair value. In this case, associate liability will be measured at option exercise price plus time value of the money. For example, the fair value of asset is 120 and option exercise price is 100 and time value of money of option is 5. In this case, asset will be sorry, associate liability will be measured at 105, that is option exercise price plus time value of money.